Have you ever wondered how foreign money flows into a country and helps shape its economy, markets, and even your investment portfolio? Well, you're not alone. And today, we're going to break down two of the most important models of global investment, FDI and FPI. These terms may sound complex, but by the end of this video, you'll know what they mean, how they work, and why they matter to you as an investor. Let's begin with the basics. Foreign investment is when money from one country is invested into another, usually to make a profit or grow a business. But not all foreign investments are the same. They usually fall into two main types: foreign direct investment, FDI, and foreign portfolio investment, FPI. Now, imagine this. A company from Germany builds a massive manufacturing plant in India. They buy land, hire workers, bring in machines, and operate the business for years. That's FDI. It's a long-term, strategic move where the investor has real influence or control over operations. FDI often includes setting up factories, acquiring companies, creating joint ventures, or opening subsidiaries. The investor doesn't just want returns. They want a presence, control, and long-term value in the market. This form of investment is considered stable because it's hard to pull out quickly. It's rooted in infrastructure, people, and assets. Now let's switch gears. Imagine a large US investment firm buying 100 million worth of Indian tech stocks on the stock exchange. They don't control those companies, they just own shares. That's FPI. This is short to medium-term investing with no intention to manage or run the businesses. FPI includes investing in stocks, bonds, mutual funds, and other market instruments. It's fast, liquid, and driven by market trends, interest rates, and global sentiments. FPI can bring quick capital to a country, but it can also leave just as fast, especially during political instability or financial uncertainty. Now let's break down the key differences between FDI and FPI. First, FDI is long-term and strategic. It involves active management or control in a foreign enterprise. FPI, on the other hand, is passive. It's about owning assets, not managing them. Second, FDI usually brings jobs, technology, and infrastructure to the host country. FPI boosts the financial markets, stock prices go up, liquidity increases, but it may not create direct employment. Third, FDI is considered more stable because companies can't pack up a factory overnight. FPI is highly volatile. Investors can exit the market with a single click. Think of it this way. FDI is like building a house in a country, while FPI is like renting an apartment and moving in or out based on how the weather feels. So why does this matter to you? Because when you see headlines like FDI in India hits all-time high, it means global businesses are betting on long-term growth and development. It often signals strength in infrastructure, job markets, and policy stability. FPI inflows signal market appeal, but they're sensitive to interest rates and global events. Smart investors and analysts watch these trends to predict markets, currency moves, and economic shifts. In conclusion, both FDI and FPI are essential tools for economic development, but they serve very different purposes. FDI builds foundations, factories, jobs, systems. FPI moves the needle in capital markets, stocks, bonds, funds. Understanding the difference helps you think globally, invest wisely, and make sense of the financial world around you.